Hello everyone, welcome to online platform of Akar Foundation. As we know, we are continuing the series of concept talk. This is the third session. Today we are going to discuss on three topics. The first one is the Viksit Bharat Shiksha Adhishthan Bill 2025. Second, India's payment revolution, and third, government fertilizer policy reform. So let's start with the Viksit Bharat Shiksha Adhishthan VBSA Bill 2025. It was introduced in the Lok Sabha on December 15, 2025 by the Education Minister Dharmendra Pradhan. At present, it is referred to a joint parliamentary committee, that is JPC, for detailed scrutiny, and the philosophy behind this bill is based on the National Education Policy 2020 recommendation for a single umbrella body for higher education, and the objective is to replace fragmented regulation with a unified technology driven and light but tight oversight mechanism. So this is the background behind this bill. Now let's see the key structural provisions. The bill establishes the Viksit Bharat Shiksha Abhistan as the apex commission. It consists of the three councils. The VBSA will perform its duty through three independent specialized councils. The first one is the Viksit Bharat Shiksha Viniyam Parishad, that is regulatory council. Its functions as the common regulator for higher educational institute, which monitors governance, transparency, and prevent commercialization. Second, Viksit Bharat Shiksha Gunvanta Parishad, that is Accreditation Council, which oversees institutional and program-based accreditation, which aims for a robust outcome-based evaluation system. And third council is the Viksit Bharat Shiksha Manak Parishad, that is Standard Council, which determines academic standards, learning outcomes, and credit frameworks, and ensures synchronization of curriculum nationwide. Now, let's see the consolidation and repeals. This act repealed the UGC Act 1956, AICTE Act 1987, and NCTE Act 1993. It covers all higher educational institutions, HEIs, technical colleges, and teacher training institutes, except medical and legal education, remain under their respective specialized regulator, that is National Medical Council and Bar Council of India. Okay. Now let's see the significance of this policy. First, separation of funding. Unlike the UGC, the VBSA will not have the power to disburse grants. Funding will now be handled directly by the Ministry of Education or a separate mechanism. Second, graded autonomy. High performing institutions receive maximum freedom, while lower performing ones face strict oversights. And digital governance. It will introduce a single window interactive system for faceless and technology driven regulations, and there will be penalty, as it will be the drastic increases in fines for violation from between 10 lakhs to 75 lakhs for standard breaches and up to 2 crore rupees for operating without accreditation. Next, then what are the potential benefits about this bill? Regulatory convergence, which means it ends the Inspector Raj and overlapping jurisdictions of multiple bodies. And the focus shifts from input to outcome, means it shifts from infrastructure to learning, employability, and research. And there will be the global integration, like facilities for universities setting up in India and Indian universities going global, and ease of compliance, which reduces bureaucratic hurdles for educational entrepreneurs and institutions. Now, let's see their critical concern. First, it may lead to excessive centralization. Critics argues it's undermined federalism as states have minimal representation. Bureaucratic control. Second, that means moving grants, giving power to the ministry may lead to political or bureaucratic interference in academic funding. Third, autonomy erosion. Concern that specialized body like IITs or IIMs might see their unique autonomy diluted under a single standard council. And fourth is implementation gap. Transition from three massive legacy regulators into one body is an administrative challenge. So, what should be the way forward? The first one must be cooperative federalism. It means establish a formal mechanism to involve state higher education council in decision making. Second, independent funding. Create an independent higher education grant council to keep financial control separate from the executive branches. And third, democratize governance, which means include representation from students and teacher association within the VBSA structure. Thus, the VBSA 2025 is a transformative step towards achieving the Viksit Bharat at 2047 vision, while it streamlines a redundant system. Its success hinges on balancing the tight standard with light intervention to protect academic freedom. So, what are the key takeaways from this discussion? VBSA replaces UGC, AICTE and NCTE Acts. It excludes medicine and law. The nodal ministry is Ministry of Education, which constitutional basis it comes under union list under entry 66, and the appointment of the members are done by the President of India on the recommendation of a search cum selection committee. Okay, now let's discuss on our second topic, that is India's payment revolution. India's digital payment ecosystem is no longer just a trend, it is a global benchmark. As we know, we are all using UPI, digital transactions. So it acts as a revolution. So how it comes? As of April 2026, the country has cemented its position as the world leader in real-time payment, transforming from a cash-dependent economy into a digital-first powerhouse. Now, let's see the latest data. In January 2026, the Unified Payment Interference, that is UPI, processed a record of 21.7 billion transactions, which valued at over rupees 28.33 lakhs per. India now accounts for nearly 49% of all global real-time payment transactions. To put this in perspective, India's transaction volume is significantly higher than that of China, Brazil, and Thailand. And UPI plays as a king, retail king. How UPI alone now commands over 81% of all retail digital transaction in the country. Okay. Then how it comes? The main pillar of this revolution is the JAM Trinity. The revolution is anchored by the JAM Trinity, which dismantle the barriers to entry of millions of Indians. How? First, Jan Dhan brought over 500 million people into the formal banking system via zero balance account. Second, Aadhaar, which provides a biometric backed digital identity for instantaneous KYC and direct benefit transfer, that is DBT. And third is mobile. India's low-cost data and smartphone penetration turn every mobile device into a virtual bank branch. Okay. So the main major pillars are Jan Dhan, Aadhaar, and mobile, through which we achieved the revolution, digital payment revolution in India. Okay. Now, what are the new frontiers in 2026? The ecosystem is currently moving beyond simple person-to-person transfers into more sophisticated financial services. How? First, credit on UPI. The interaction of pre-approved credit lines into the UPI interface has become challenging traditional credit cards, allowing user to buy now, pay later using a simple QR scan. Second, UPI Lite and offline payment. To solve connectivity issue in deep rural areas, UPI Lite allows small value transaction, that is under rupees 500, to be completed without an internet connection or a PIN, reduce the load on bank server. And third, global footprint. UPI is now operational or linked with national systems in countries including the UAE, Singapore, France, Mauritius, Nepal, and Sri Lanka, making cross-border travel and remittances seamless for Indians. Now, the RBI's first safety first mandate. Why it is important? The massive volume comes the need for massive security. As of April 2026, the RBI has proposed or implemented several guard layer measures to curb digital frauds. First, lag credit. A proposed 1 hour delay for the first transaction over rupees 10,000 between two users to prevent authorized push payment, that is APP scams. Second, kill switch control. User can now instantly disable all digital payment modes on their account through a single one-stroke command if they suspect a breach. And third, trusted person authentication. What does it mean? A secondary layer for security for senior citizens, that is 70 plus person and person with disabilities, where a nominated, that is trusted person, must approve transaction above 50,000 rupees. Then what are the economic impact it achieved? The shift to digital has drastically reduced the cost of printing and managing physical currency. More importantly, it has created a digital footprint for small merchants like chaiwala, street vendors, and MSMEs, allowing them to access formal credit and insurance for the first time in history. And India's journeys from Q to QR codes is now being exported as a model for financial inclusion to developing nations worldwide. These are the major economic impact. Now, from the discussion, let's discuss the major key takeaways. First, as a point of data, the key takeaways are: first, global leader. India handles almost approximately 49% of global real-time payment, more than any other nation, and the monthly UPI transaction has crossed 22 billion, valued at over rupees 29 lakh crore, and UPI facilitates 81% of all retail digital transaction in India. As we discussed earlier, it acts as a retail key. Then on technological evaluation basis, credit on UPI, user can now spend via QR codes using pre-approved credit lines instead of just bank balance. Digital rupee, the CBDC is now fully interoperable with UPI QR codes with 7 million plus users, and it also provides offline access, like with the help of UPI Lite, allow small payments under rupees 500 without internet or a PIN. On global presence, international link. Operations, it is operational in Singapore, UAE, France, Sri Lanka, and Mauritius. UPI One World allows foreign traveler to use UPI without an Indian bank account. At security and regulation basis, safety lags, a 1 hour delay for the first large payment over 10,000 to new recipients to fraud and mule detentions. Bank use AI-driven monitoring to instantly freeze suspicious account used for laundering. On social and economic impact basis, first is credit access. Digital footprints allow small vendor to get formal bank loans for the first time. DBT efficiency, that is direct benefit transfer efficiency. The Jan Trinity, that is Jan Dhan Aadhaar Mobile, ensures welfare money reaches the poor without linkage. And cash reduction, lower cost for the RBI in printing and managing physical currency. So these are the key takeaways from India's payment revolution system, which we have achieved. Now let's discuss the third topic, that is the government fertilizer policy reform. The government fertilizer policy reform as of 2026 has the focus has shifted from mere price control to balanced nutrition and fiscal sustainability. The current situation as of 2026 is: first, fertilizer is the second largest subsidy after food. The 2025-26 budget allocated approximately 1.9 lakh crore rupees to keep prices affordable. Second, nutrient imbalance. Historically, the over-application of nutrient, that is nitrogen, relative to phosphorus and potassium has degraded soil health. The ideal NPK ratio is 4:2:1, but in many states it exists 8:3:1. And third is import dependency. India remains highly dependent on imports for phosphatic and potassic fertilizers and raw materials like gas and rock phosphates. Okay, these are the current situation we are going through. So, what are the key reform pillars? First one is one nation, one fertilizer. All subsidized fertilizers are sold under a single brand name, that is Bharat. What is the purpose? To standardize fertilizer quality across the country and reduce cross movement of brands, which lowers fertile subsidy cost for the government. Second is nano fertilizer revolution, which it is the introduction of nano urea and nano DAP, that is diammonium phosphate, in liquid form. What is the benefit for this nano fertilizer revolution? That is, one 500 milliliter bottle of nano urea replaces a 45 kg bag of conventional urea. It has a higher nutrient use efficiency, which is 80% plus compared to 30 to 50%, and reduces environmental runoff. Next, third is PM Pranam scheme, that is PM program for restoration, awareness, nourishment and amelioration of Mother Earth. What is the mechanism under this scheme? States that reduce their chemical fertilizer consumptions are rewarded with 50% of the subsidy saving as a grant. These grants can be used for creating assets related to organic farming or technological adoption at the village level. Fourth is neem coated urea, NCU. Mandatory 100% neem coating of all subsidized urea. Then what will be the impact? It will slow down the release of nitrogen and prevents the illegal diversion of subsidized urea for industrial purpose like chemical or plywood industry. Next is last pillar is nutrient based subsidy reforms. Currently, NBS applies to potassium PNK fertilizer, while urea is under statutory price control. 2026 update is that discussions are going on to bring urea under a modified NBS like framework to discourage overuse and promote balanced soil nutrition. Okay. Next, under this fertilizer reform, the next step government is going to take is the direct benefit transfer 2.0. Point of sale 2.0 means subsidies are currently paid to companies after the farmers buy the fertilizer via Aadhaar enabled POS machines. Point of sale. Okay, the goal is to moving towards direct cash transfer to farmers bank account similar to PM Kisan to allow them to choose between chemical and organic fertilizers. Okay. Then what are the challenges we are going to face due to this reform? First challenge is soil degradation. Excessive urea usage lead to soil acidity and decreased crop yield over time. International volatility, global gas price, that is raw material for urea, directly impact India's fiscal deficit, and political sensitivity is that increasing urea prices is politically difficult due to the large farmer vote bank. Okay, then what are the way forward? Promotion of natural farming. integrating the PM Pranam with the Paramparagat Krishi Vikas Yojana, that is PKVY. Second, gas pipeline grid, that is completing the national gas grid to provide cheaper raw material to domestic urea plant. Third, biofertilizer, mandating the use of fragmented organic manure FOM produced from compressed biogas plant. Okay. Then the evaluation of India's fertilizer policy marks a transition for food security to ecological security, that is maximizing quantity to optimizing quality. By integrating cutting edge technology like nano fertilizer with fiscal incentives like PM Pranam, the government aims to bridge the gap between high crop yields and soil health. Second, for a truly Viksit Bharat, the path forward lies in reducing the fiscal burden of subsidies while empowering farmers to adopt balanced fertilization and natural farming. Success will depend on the effective implementation of the direct benefit transfer and the ability to insulate the Indian farmer from volatile global commodity market. Okay, so now let's discuss the key takeaway points from this discussion. First, under core scheme, what are the three main core schemes? First, PM Pranam. Second, One Nation, One Fertilizer. Third, neem coated urea. In under PM Pranam, incentives states incentivizes states to reduce chemical fertilizer use. 50% of subsidy savage are given back to the state as a grant for sustainable asset. One nation, one fertilizer means all subsidized fertilizer sold under the single brand, that is Bharat, to reduce logistic cost and standardize the quality. And neem coated urea, that is NCU, is 100% mandatory coating to slow nitrogen release and prevent illegal diversion to industries. Under technological shift, first, as we discussed earlier, nano revolution, focus on nano urea and nano DAP in liquid form, as one 500 milliliter water replaces a 45 kg bag, increasing nutrient efficiency and reducing soil runoff. Second, digital soil health card linked to fertilizer purchase to encourage site specific application rather than blanket overuse. Under subsidy and pricing, first comes urea pricing. Remains the only fertilizer and with statutory price control. That is, the price is fixed by government. Second, nutrient-based subsidies applies to potassium and phosphate fertilizer. Subsidy is fixed based on nutrient content, but market price fluctuates. Direct benefit transfer 2.0, moving towards direct cash transfer to farmers' accounts to promote choice between organic and chemical option. Major challenges are NPK imbalance. Ideal ratio is 4:2:1, but it has been increased to 8:3:1, which causes soil fatigue. Import dependency, heavy reliance on foreign gases for urea and rock phosphate or potash. And fiscal stress, high global price lead to massive subsidy bills. Approximately it is 1.9 lakh per rupees. Okay, so I hope this session is helpful for you during your preparation. Thank you everyone, and if you like this session, please do comment on the comment section, and please like, share and subscribe to our channel. Thank you.